When Microsoft Internet Explorer, when you press Alt-Tab, it goes to another tab. It doesn't switch the application. It's so silly. All right, should be an action close here with VIX in the high 20s, crypto blundering, and NVDA now red, but the S&P 500 is trying to hold 66. Economic data was solid today. Back to employment reports with numbers coming out, look decent, but not enough from NVIDIA, and that's the rub basically. Tried to rally, failed. Not the worst, still mostly crypto-centric, but VIX 25 right now says you're going to have a pretty juicy session. Tomorrow, today, Chicago Future Finance live from Cboe, starting up here, 2 p.m. every day, Tuesday, Wednesday, Thursday. NVIDIA right now, 183. Holding the line in the sand, so we'll see how we end up. See you there. All right. Yeah. Good afternoon and welcome to Chicago, Future of Finance. I'm Oliver Renick. We've got an hour left and it should be an action close here. Crypto is blundering. MicroStrategy is still leading risk off, but equities are putting up a good fight. The S&P 500 right now is trying to hold 66. It's a key level and it's a line that I drew earlier in the week. Let's get straight into it. This is going to be a really important session as tomorrow closes out a week into the holiday for Thanksgiving next week. So if volumes lighten up at all, then we could get even more swingy, and VIX at 25 says get ready for action right now. Here's a chart of the S&P. There's the line I drew yesterday. Is that going to hold up? We did find some support intraday. We're fighting for it right now. You can also see from the selling back in October, we were able to hold that line. The last 2 days, we also held that line. If you go to NVIDIA, then you've also got a pretty notable 180 level that's trying to hold here right now. 180 on NVIDIA is important too. If you look at Bitcoin, that obviously has been the worst. The line that we had there just shattered at 100,000. So to go through some of the key points here, this morning we did get economic data, which was all right. It wasn't terrible. The fact that we did get some economic numbers finally, and the employment situation really wasn't bad at all. I do think that that's worth noting. The fact that you got a pretty sizable report on the economy, employment situation, added 119,000 jobs. There's the look right there. So that's not terrible. Unemployment rate 4.4%. That's pretty much held pretty consistently. So, it could be worse for sure. The other numbers that are coming out, I think that are going to be relevant. Jobless claims were pretty much in line with the trend that we've seen. So to get numbers back into the groove of things does help us out. Though you'll see there's really nothing going on. Bonds are rallying a little bit, nothing on the macro that seems to be responding to the data so much. You do obviously see the bond trade basically just kind of holding where it's been. The dollar also little change today. The chart of bonds too has been, I think, pretty much consistent. A point that I've made on the risk radar, which has been bonds holding on basically for the 10-year yield. That's roughly at 4.1%. So you can't really look at the data and really weave much of a narrative on that front. I do think that generally the data have been pretty cooperative when they were not coming out. Now that the data are arriving, it gets a little bit, potentially complicated if numbers start to weaken. But today, that's not what it's about. This is just a fade in NVIDIA and continued weakness in crypto that I think is the main culprit. So that being said, here's the look at the risk radar. I'm feeling pretty good about this right now. Yellow for bonds, yellow for dollar, red for Bitcoin, yellow for stocks, and green for gold. Gold is right now just totally flat, so gold is doing what it should. That's definitely encouraging, the fact that gold is holding on while risk is coming off. I think that because gold had such a big move, it really wasn't obvious how gold was going to perform if the market did just take a dump. And it's not really doing that. Keep in mind, S&Ps are only down right now 60 points, but that is getting closer to the lows of the session, so it's not looking great. Obviously, we careened off a cliff at 10 a.m., but we're still kind of holding, and if the market does hold 66, then yellow holds on my light. If we come back to the S&P 500 for a second and just look at the chart, I think that you kind of get an idea of maybe where I would want to flip that. And I think it's essentially anything below 66. I think if you close below 6,600, then the red light for stocks may be on my risk radar is something that we need to think about. But generally speaking, this is a pretty, orderly kind of steady selling. There's nothing really too dramatic, I don't think, just yet. Obviously, crypto is where the drama is. That's why I've had the red light there, because that one's just very clear. The fact that you have had this big move in Master now being followed by Bitcoin is obviously disconcerting for anyone that is thinking that Bitcoin's going to be able to make big moves beyond 100K. To put it in perspective, how low will Bitcoin go this year? That was one of the main bets that we looked at on Kalshi. To bring that up again real quick, this is the look, the odds that Bitcoin will go now to below 80,000 is above 51% on Kalshi. That is a pretty notable move. Below 70,000, it drops to 23%. Yesterday, Scott Bauer was saying that he would take, the odds that Bitcoin doesn't get to 200 by the end of 2026. That was another one that we looked at, which was, will Bitcoin be above 200K by 2027, aka end of next year? Those odds are now at 18%, which have dropped down from 20. So it's not a good situation for the for the coiners. But I think that we have seen worse days for coins. I think the bigger question is if the S&P 500 is going to follow suit. And I don't know if the chart really has given us too much to be concerned about unless we crack through 66. Let's talk volatility and more with Noel Smith, who is joining me today from Convex Asset Management. Noel, when you look at the market, obviously the biggest weakness is in crypto, but it's disconcerting to see NVIDIA get dragged after earnings. What stands out to you right now?
Crypto seems to be driving the bus right now, which is a little bit confusing to me. If you look at everything in the AI space, nuclear, obviously NVIDIA, You see a lot of put activity, and frankly, I'm pretty surprised. From a vol standpoint, the move does seem pretty overdone.
25 overdone for VIX?
Depends if you're looking at a close to close or a intraday realized volatility measure. So the market has moved a ton today, but the market relative to yesterday, not moved that much. So depending on where you think that marginal action is going to come from, if you look at the systematic funds that are forced to sell when realized volatility ticks up or implied volatility ticks up, then you can see that there is a bear case for this. But as so far as the NASDAQ down 4% from the peak this morning, that does seem very high to me.
Vol and the NVIDIA premium that was all built up around today, it's kind of surprising to me that that's not coming out more after the event. I guess maybe for NVIDIA itself it is, but it kind of looks like it transferred over into the market a little bit, to your point, more broadly. So tell me kind of how that, the NVIDIA volatility versus kind of the broader market volatility, how do you see those playing against each other right now?
So I'm pretty surprised. I expected the market to go up this morning because the futures, whatever, after NVIDIA beat. And then I expected volatility to kind of come in. And then with that, the delta on those options that are struck out of the money starts to get smaller. And that creates a reflexive bidding activity within the marketplace. And we're going into a holiday. It's a Thursday before a holiday week. We're going into December. So frankly, I think that vol can't really stay here where it is unless we get more realized volatility. I feel like it's too high. And it's too large of a move.
What would that look like if realized vol were to catch up to implied here? S&P cracking 6,600, or what does that kind of rough math look like for you? What does the VIX tell us we should be at for the actual market?
So you're exactly right. If we break, there's not much below. Okay, we could break and it could be really nasty. We're going into the last month of the year. I have no idea from a narrative standpoint as to where the market goes. I can only tell you from a volatility standpoint what's the market's actually trading. And it does seem like I just don't see a justification other than today's volatility for that ratio between implied volatilities and realized volatility to stick.
Yeah. I pulled up your chart here, 1 month realized vol versus VIX. Make sure we can see that little corner there. There it is. Okay, so SPX 1 month is in the orange, VIX. So your point here is that, other instances in which we saw this really pop, the blue line for VIX, S&P's got to follow pretty soon, or else VIX has got to come down. So is this you think we could close this gap by tomorrow, or what's kind of the timeline for seeing these two come together the way you might expect?
I would expect vol to get pounded next week. That's what I would expect. So the idea that we do nothing for the next couple of days, or tomorrow being options expiration, fine, that's in play as far as I'm concerned. But the idea that we go into next week and vol just sits around and at a high level without the kinetic energy of a lot of realized volatility, that I don't see.
Okay. So then, it looks like right now, other than earlier this year, the tariff stuff, it's been pretty reliable to kind of see, realized vol remain pretty low. The regime, we assume, is kind of like, if we then cool off, we get back to 16 VIX, something like that?
16 VIX implies a 1 day, 1% move, which that honestly does feel more in keeping. The idea that I can pick 16 out of a hat, I have no idea. But the idea that it's going to stay at 25 or 28 this morning, I want to fade that. I don't think we go much higher.
What's the best way to fade it? Buy dip in stocks, sell VIX calls, sell S&P puts. What do you think? There's a lot of different ways. If you think that implied vol is too high, what's the best way to go about juicing that trade?
Very good question with a very nuanced answer. There's many different ways to do that. And the answer really lies in the vol path of what's going to happen. I typically try to buy Delta 1 instruments without gamma or spreads or ratio spreads in the VIX puts. Because what's going to happen is if the market does bounce, if volatility comes in, if you're long VIX puts, those things are just going to get destroyed. So the idea that you can go out there and buy a bunch of 20 strike puts in December or something like that, those things are going to get murdered. From a vol standpoint, they might go up in price, but they won't be as reactive as you're wanting them to be. So I'd rather just own the index or put spreads.
Okay. So I think a lot of people want to hear that. There's probably some people in that trade already, right? I think that the numbers for NVIDIA weren't so bad that you assume, the things are going to fall apart here. But, between Michael Burry, a few of the other shorts that are kind of out there, I do kind of wonder if some of the AI narrative is turning somewhat sour. Look, I'm not the expert. I'm not, I'm not the equity analyst. But the numbers do not seem like, something terrible. I know there's an argument to be made about, how much usage there is for the chips versus how much they have. Is there oversupply? But, every headline I see is just more and more embrace of it. Like I saw something about Jack Dorsey and what he's doing with XYZ, and it's hard for me to look at the NVIDIA numbers and say, okay, this should be a massive sell-off. Now, if crypto and Bitcoin go below 80,000, then all right, like I could see that really start to pinch risk off a little bit more. But to your point, I'm kind of thinking most people are going to be trying to sort of buy this AI dip of in some fashion.
I guess I would agree. I don't understand the narrative any more than anybody else. And you said you're not an expert, but there's nothing but experts that do this all day, every day for a living. And they're just as confounded as anybody else. The idea that NVIDIA would be a $4 trillion market cap or a $5 trillion market cap, you tell me what's wrong. I mean, if you had the best cup of coffee in your life, is it worth $5? How about $50? How about
try Phil's coffee below my building? It's
Crazy.
More like 7.5.
There you go. But it's some valuation. I just don't understand these prices. So I really do stick with the vol markets because what they're showing me is where is the rubber meeting the road? Where are people putting their money insofar as something is actionable? Now, the trade narrative, I have no idea, right? Like I understand it's the future, et cetera, but at what valuation? But I can see that vol's popped. I also see that we're going into the last month of the year. I see that the spread between realized and implied volatility is quite high, 98th percentile. You look at that graph right now that you just put up. Look at that thing. It's like, it's extremely high. So do you want to tell me you want to try to buy that or you want to try to sell that? That's an obvious decision to me. You want to sell that.
Okay. When would the narrative change in your mind? When would breakdown be more notable?
We're not too far from it. From a volatility standpoint, things are getting dicey, right? I understand that we had a really large intraday move, but there's not a whole lot more of today's in the market before that just kind of breaks, before realized comes up to implied. That's what I mean by that. So if we start getting a realized close to close volatility, closer to 25 or whatever else, the VIX will go to 30, 35, something like that, and the market's not going to hold.
Yeah. Okay, so this chart tells us that more often than not, you're getting paid to fade the implied vol here. There's a lot of different ways to do it, either being long underlying equity, being short volatility. The names too, if you want to get specific on the names, you could do it that way, but I feel like to your point, you're making more of a macro kind of market point. I feel if you try and do this through sector, stock, or whatever, you might lose the forest through the trees a little bit because we still got earnings coming through, and there's going to be a lot of stock-specific stuff that could potentially muddy up that trade, basically. I think what you're describing is a macro trade. I mean, look at, my favorite lately has been Alphabet, by the way, and the chart is doing just fine.
Yeah, that's absolutely right. So in terms of the single names, the amount of market signals that are quality that comes out of single names, it's a lot more difficult. So, when you have the S&P 500, you can get a lot of actionable information out of that. But if you're even looking at Google, which is a gigantic name, it is still a lot more difficult to get signal from noise out of that options complex.
Yeah, love it. Noel, any final words, last thoughts? We're really fighting to hold these lows of the day by 66. I got to let you jump, but if you got one closer for me, give it to me.
I mean, vol is bid. Options and VIX are bid. I bought some VIX call spreads this morning. That part's working out, but also the idea that, we kind of did fine for the first part of the day and then all of a sudden just collapsed. I don't really know what the narrative is, and frankly, I don't really care what the narrative is. But vol is right now kind of at the precipice where I would start to reduce risk if we go down a whole lot further and realize volatility picks up a whole lot from here.
Love it. Love the charts. Love the perspective. Thank you, Noel, very much, sir.
Thanks.
You got it. Good stuff. All right. Short little break here. We've got David Litchfield joining us, Director of Derivative Sales at Cboe. Talk about some of the hot stuff going on, not just in the market, but product-wise too. We had a great conversation in Munich, Germany. We'll revisit some of those themes when we come back. The innovator buffer break. See you in about 2 minutes. There are two things about Chicago finance you can't get anywhere else. The first is kind of hard to miss. Everyone's trading options. Cboe is on a 5-year growth streak making billions, and its goddess of grain sits atop the final pit of open outcry. And that's what it's all about. The chance to fend for yourself. A fortress for the self-made trader, and the only still standing in America. The second thing you may not know, but it's worth trillions. Chicago is the only major city in America that's home to 2 of the top 10 registered investment advisors, according to Barron's. That means a steady river of passive money and fixed income pouring into the city. If you think you can beat the market, this is where you do it. If you've got value, price will discover you here in Chicago, the future of finance. Join me, Oliver Renick, from Cboe, Tuesday, Wednesday, Thursday, into the closing bell, live from Chicago. Welcome back to Chicago Future of Finance. I'm Oliver Renick. I'm joined here with Mr. David Litchfield, head of derivative sales at Cboe, live and in person here at the floor. Great to see you, David.
Very good to see you too. How are you doing?
Good. You're here on an action day as we've got the market kind of trying to figure out where it wants to go in the next, we got 40 minutes left, but you're continuing a conversation that we started in Germany when we were at Cboe RMC, which was about credit futures, which was actually a fascinating thing for me to learn about because it was a fairly kind of new thing that, well, not new, you guys have had it with BlackRock for a while, but I think people are still learning about them and institutions are coming into that market. So give me the latest. What's been going on with that?
Yeah, that's exactly right. So more and more institutions are coming live all the time. We saw a peak in open interest the other day, topped $1.3 billion in the high yield futures, and the volumes are growing. So as those users are coming to market, more liquidity attracts more liquidity. So we saw $200 million trade through the order book. So that's a very good indication that the actual liquidity is very, very strong in the order book. Okay. Off-screen liquidity is still strong because of the tie to the ETFs, and that's obviously always available. But that on-screen liquidity is something that we're really keen to push through. It allows many more traders to access the product and express their views.
What kind of traders? How much have you been able to see what's coming in? Who's kind of the marginal participant right now?
So we have what I might describe as anchor clients, so a couple of insurance firms, asset managers using it for both longs and shorts. And one of the other user bases that we're really trying to attract, which is where that screen liquidity is so important, are the CTA community. So this offers them corporate credit in a futures wrapper, a part of the market thus far they've been shut out of because there has been no futures wrapper for them to trade. They of course trade commodities, trade equity futures, now they can trade these corporate credit futures, and it's demonstrating that screen liquidity, which is why it's so important that these big trades go through and print on the book.
Using it to hedge?
Yeah, so CTA is using it, classic trend following strategies, but the great thing about this product is it's democratizing those credit markets. The derivative space in credit has been occupied mainly by the OTC instruments, and that's obviously only available to the large institutions with ISDAs that are able to trade that. Democratizing these markets, we see a lot of activity come through the retail broker channels. So it democratizes their access to that derivatives market that, as I say, has been shut off to a number of users. And we have users looking to use the product long and short, and for different time frames. So it's not just liquidity providers having to absorb that liquidity in times of stress. We actually see clients trading against other clients in the order book.
Tell me about the kind of structure of the product. Again, remind us from that initial conversation of how you figure out what's represented in the underlying, because the credit universe is huge.
Yes, exactly. And that's one of the magic sources behind the product is how do we get it liquid? If we launch another equity future, then cash equities trade all day long on exchange. Liquidity would not be a problem at all. With corporate credit, you can't transact 1,300 high-yield bonds to hedge your high-yield future. Similarly, investment grade has 2,800 individual corporate credit bonds that's underpinning that future. So that universe is explicitly tied to the ETFs. So IBHY, our high yield future, is explicitly tied to HYG, and IBIG, our investment grade future, is explicitly tied to LQD. And those ETFs trade $3.5 billion a day on exchange, and because of that explicit tie, the liquidity can be ported from that ETF market into the futures market.
I guess I just kind of assume that tied to LQD is probably a bigger market than HYG, or
so this is the interesting thing, exactly. So assets under management, one would assume that the LQD ETF is the biggest market, and that's correct. Trading volumes, HYG has typically been traded more frequently than the investment grade ETF.
Okay.
And number of reasons.
The LQD, they kind of just have it sit there, whereas HYG lends itself to what, more of an active trader?
Exactly, and that's been the theory all along. I would actually put the other side of that argument through, is that the number of users out there that can't access those ETF markets aren't able to trade. And actually the futures enable them to trade. So we see a lot of volume go through the investment grade future, as we do the high yield future. And if you look at the OTC markets, CDXIG trades normally around $20 billion a day, compared to CDXHY that trades about $8 to $10 billion a day. So actually, I think the number of assets and users out there that can't access this market until these futures actually want to trade more in the investment grade space. So my prediction is that the investment grade future would trade typically more than the high yield future in maturity.
Which tracks, I think, makes sense. I guess the macro backdrop right now is quite calm for bonds. We were just looking at the chart for 10-year, and it's basically been sitting right at 4%. So I can't really look at the market and say, okay, I think there's going to be more action in one part of the bond. There's just the bond market's not really giving us much right now. But I imagine that kind of helps people zero the scale to figure out how to use these products, because the market's not giving us a ton of direction. I mean, I might be missing something, maybe a high yield or some of the other subsectors, but just the broad treasury market, the ocean on which all these things kind of floats is quite calm.
Yeah, but I think we're hearing more and more, of course, about the AI story. And NVIDIA last night, fine, that was a good beat, but it's obviously down today. So I think this AI story and idiosyncratic credit risks will come more to the fore than they perhaps have done in years gone by. And that again is where developing this market and democratizing this market, and the options that we've launched on the futures as well, allows investors more precision instruments to express their views. So of course, short sell some futures to hedge, but actually what about trading a put or a put spread or selling some calls? I've been going on the equity world forever. This hasn't been possible in the credit markets until now.
When you're looking at the growth of the product, is there anything since we were it was Oktoberfest in Munich, so it was October, September, has anything changed that you think beyond just kind of the education of the product that's pushed people into these, or is it just awareness?
It's still education, still awareness. It's getting that message out there that these things exist. And then, as I said before, the crucial message that these things don't just exist, but they're liquid and you can trade them in good and big size. Because on an average day, the volumes might be low, so optically it might not be liquid, but as I say, saw $200 million trade through the order book. And even a $30 million clip was put on the bid, and a few seconds later it was hit. So you don't need to plow through levels of the order book to achieve your liquidity or chip away at this thing over time. Liquidity is there to be had.
David, when you are thinking about the potential for this to be, I mean, it's largely institutions, big players. Where does it have the ability to kind of go down the scale? If if part of my net worth is, real estate, I might have interest in some kind of credit, hedge. If I have a big part of my portfolio that's in bonds, I do think that a lot of people right now are trying to figure out the 40 part of the 60-40 portfolio. And there's all these solutions to it. There's, options-based solutions. That's a lot of what we talk about here, right? Is people are saying that, okay, our fund is a solution to the fact that you can't rely on bonds anymore. But the credit futures and credit futures kind of give you another way to say, all right, well, I can kind of hedge the bond part of my book with this, and I feel like everybody's vying for that part of the portfolio, whether it's private equity saying you need to be, diversified with our assets. Do you hear that? Is that part of the conversation?
Yeah, absolutely. And even, as I say, going into retail platforms, so we do see significant volumes come through the retail platforms. So the margins and the notional size isn't prohibitive. Of course, it's a lot larger than natural ETF, but by the time you lay down your margin, it's not unrealistic to suspect that retail do use it, certainly high net worth individuals. But then on that institutional side, as you say, if a bond portfolio manager has taken a longer time to find these individual credits, they don't perhaps become available all the time. The last thing they want to do is sell them and get rid of them. So use beta to hedge. and use that future to hedge the risk rather than having to sell individual credits that you might have taken a lot of time to try and track. So all these different use cases come in, and the options lend even more diversity of that liquidity.
Right. Well, then you get to the more of the speculative element, right? Because you guys have the options on the futures where if I'm thinking about myself on how to, because part of that question was, will a retailer, will an average person have interest in this product? Well, if you got options on it, then fair game, baby. Maybe I want to start speculating in credit, right? I mean, like, it's not that unreasonable.
Yeah, absolutely. And again, that diversification of liquidity pool and the democratization of the credit markets is something that we're very, very excited by. And it lends itself to liquidity perfectly, because if the market is selling off, you're like, well, who's buying this stuff? Well, of course, there's a liquidity provider at some level that will buy it. But if you have the options market, if that skew's gone really expensive, well, you might want to take advantage of that by selling some puts and buying calls. Now, if you're doing that, expressing your view via the options market, whoever's hedging that position on the other side is naturally going to be buying futures. So it lends that support mechanism, and the options market helps liquidity, as we well know.
Yeah, we can hear the liquidity behind us. David, great to catch up. Thank you for coming down.
Thank you for having me.
Good to see you in Chicago.
Good to see you too.
And fun to get the update on the credit futures as well. I feel like we kind of put that spotlight on in Munich, and volumes have gone up. Great to see you, David. Thanks a lot.
Thank you very much.
All right, we got a short break. We'll be right back. 2 minutes, then we're going to talk some ETFs. We're going to go into the thematic world with VistaShares CEO Adam Patti joining us. Got some really interesting funds under their roof. We'll be right back. All right, welcome back. We are jamming here as the S&P 500 drops below the key level, 65.79 right now. 66 is what we're watching, and we are below it. Of course, NVIDIA is not helping after a rally and then fade post earnings. Let's talk some thematic ETFs. Joining me, Adam Patti is the head and CEO at VistaShares, which has got a lot under the roof. Adam, thanks for being here.
Hey, thanks for having me.
You guys are obviously very plugged in, quite literally, into the thematic world, and some stuff that I think is relevant on a day when we're thinking about AI, disruptive potential, what's been overhyped, what hasn't been. Tell me, firstly, kind of from the larger AI thematic side, what do you think about kind of the way folks are responding to NVIDIA and semis and all things tech today?
Well, it was an interesting reversal we saw today. I mean, quite interesting. Look, I think the market spooked. I think, look, the underlying fundamentals in the AI infrastructure trade are sound. We saw that in the NVIDIA earnings yesterday. It's a durable theme. It's growing and it's accelerating, in fact. Hundreds of billions of dollars in CapEx are being deployed into AI infrastructure. The key is really how do you get exposure to that and really follow the money to get access to those profit pools.
You guys have two funds that I think do hit this. First is the VistaShares Artificial Intelligence Super Cycle ETF, AIS. Let's start there. Tell me about it, Adam.
Yeah, so what we do is we have a very unique process. We are looking at where the cash is going. So when people say they're investing in AI, you got to really understand what that means, right? There's many different segments of it. So what we're doing is we're analyzing the supply chain. Then we overlay the bill of materials. So we're looking at the supply chain of what goes into building an AI data center and an AI semiconductor. We analyze that. We do the analysis to try to determine which segments of the supply chain are driving the most economic value. Then we find the companies and map them to those segments. So it's a picks and shovels approach. In other words, when Meta invests $100 billion into AI, what are they doing? They're investing in building out data centers and they're buying semiconductors. That's where you want to invest. That's where the profits are, and that's where the investors are going to yield the best returns, we believe, over the next 3 to 5 years.
Looking at it right now, AIS, you've got a very international element to this, which I think is important. SK Hynix is number one in the weighting, 7.7%. Micron right behind it, 7%. And by the way, I'm just going to flip over real quick to show the chart on this thing, give you some love for it. Year to date, 45%. I mean, that's absolutely killer.
Yeah, I mean, no surprise again, because all the money is flowing into the sector and we are buying the companies that are soaking up that investment. So I like to point out one interesting thing. When people say I'm going to invest in AI companies, most people don't realize that 30% of an AI data center build goes into cooling systems. Boring cooling systems, right?
Oh, yeah.
So we invest in those
Doesn't
companies.
work without them.
Right, like Vertiv, that's our number 3 holding. It's a very important company in the build for an AI data center. So, this bill of materials process is really what differentiates us, and the expertise behind, the active component of our funds. We have a lot of expertise on board to guide the portfolio.
Vertiv there, number 3, just below 5%. AMD is in there. I love the picks and shovels aspect for AI because I know that they're actually digging up gold right now. One of the big differences in my mind between the crypto craze and what we've seen for artificial intelligence is that the products are just hitting my life from every angle, whereas I went a decade without using crypto until some of the poker websites said, you got it, So the real picks and shovels here are making a big difference. And of course you do have NVIDIA in there, you've got Intel. Also you hit GE Vernova, which was a pretty big winner too. Tell me about the process though, how do you find them? Tell me about the team and the kind of selection system, the screening system to get these names, because I will say it's a pretty diverse basket.
Sure. So, we have a very unique process. So the core of our portfolio is rules-based. And what that means is we have built what we call our bill of materials process, where we analyze the supply chain, as I mentioned before. Then we overlay the actual bill of materials on what it costs to build. Each component goes into building an AI data center and a semiconductor. And that's how we build our core portfolio. So it's fully rules-based and transparent. In fact, we have the rules right on our website. We filed a patent on it because it's very novel. But the beautiful thing and the most interesting thing is that in a fast-moving industry like AI, you need people who actually know the industry and understand the industry. So our investment committee, because we are active, so we have a rules-based process as the core of our portfolio, but we have an active overlay. So that is made up of people like John McNeil, the former president of Tesla, Sunny Madra, who's president of a company called Grok, GROQ, which is one of the core, most important companies involved with Saudi Arabia's Humane Inference Center, for instance. These are the experts who we have on board that are actually building data centers every day. They understand the companies, they understand the technologies. Their job is to identify risks and opportunities in our portfolio. Once they do, then it goes over to the portfolio construction people, which is myself and Professor Robert Whitelaw. Professor Whitelaw is the dean of NYU Stern School of Business and chairman of the finance department there, a world-renowned expert in portfolio construction. So we have the practitioners who are building data centers, who understand the space, and then we have the portfolio construction people to express their views into the portfolio.
I'm looking at your guys' white paper right now. Growth of AI, estimated global market value in 2025. You have it at just shy of $400 billion. And then by 2030, 16 trillion. Big numbers, Adam, big numbers. But you've already seen hundreds of billions, as you've got it here, from the main leaders already. So it doesn't seem like a big stretch. Unless, I don't know what, the market crashes and there's some kind of feedback loop. If, shares go down, funding, it's just, but again, it's hard for me to figure out kind of what the big, like why they would stop building these things out. One could possibly be the resources, to your point. Like here in Illinois and Chicago, we've got power, we got water. Why don't we have more of the picks and shovels ourselves? You kind of start to run into some of the government inefficiencies and whatnot, but I'm curious what you think.
Yeah, look, I mean, so AIS is this portfolio, this ETF, and look, the AI industry it's an arms race, right? I think we've all determined that it's not only countries on countries, but it's companies on companies, and unless we're seeing a major black swan event, it would be unlikely to see a pullback in capex spending. These hyperscalers have already signed multi-year, hundreds of billions of dollars contracts that are going to go out 3 to 5 years. They have to. If they don't succeed, they're going to be irrelevant. And that's really why trillions of dollars are flowing into this space and why it's going to keep going for a long time. The key, again, though, is that the reason why they're investing is that they're looking to create enough compute so they can create applications that one day create enough value where they can make money on the front end from the consumer layer. That's down the road. Where the money to be made right now is in as you mentioned, the picks and shovels. It's the cooling systems, it's the fiber optic cable, it's the GPUs, it's the networking equipment. It's all those pieces that go into building the compute. That's where we are for the next 5 years.
And that approach means that you also omit and you avoid any potential leadership risk, having to pick a winner, competitive risk. Like I know there are people right now that are really taking I don't know what to call it, to NVIDIA's earnings, like a scalpel, really looking for something. There's, a lot of OpenAI haters out there. So, you don't have to pick your horse, basically. You just pick the track they're going to run on, and I don't know much about horses. And that analogy just hit a wall there.
It's a good analogy.
The guy who makes the horseshoes, I don't know.
It's a good analogy. I mean, NVIDIA is not the full story. They're a big part of the story, but in terms of the stack that goes into building the data center, they're only one piece of the puzzle. And that's what's really important to understand. There's the AMDs, there's the GE Vernovas, there are all these different companies that are critical to the build out of AI.
I'm looking also, by the way, just to reiterate a point I made at the top, I was just kind of eyeballing the fund and noticed it, but it seems like you guys do take a significant amount of effort to show that this is an international index. This is not just US. You've got a comparison here to the average AI benchmark. I am wondering how you devised that benchmark, though. Was that looking at just indexes or ETFs that were on offer at the time you put together this paper?
Yeah, we look at the largest assets under management ETFs in the AI space, try to determine what their portfolios look like. And look, the reality is, and no shot at them, it's mostly Qs. If you look at the exposure that a lot of these AI ETFs have, it is really the top 10 holdings of the Qs. So
I've seen that as well. Yep, closet indexers, as they say.
Exactly. That's why it's critical to look under the hood. So we like to show the overlap analysis, because when you buy AIS, you're getting companies, most of which you probably have no exposure to or very little exposure. And that's what you want in a thematic product. You want to diversify your exposure. You don't want to over-concentrate your exposure into the same companies held by the S&P 500 and the Qs.
Yeah, that's very fair. Okay, now thinking about generally, when you look at the international side again, though, does that have any volatility around geopolitical stuff? Some people like to just get the U.S. specific, but I will say that I think the performance kind of speaks for itself. This is outperforming semiconductors alone. It's outperforming the Mag 7. At the start of the year, the international side was a good piece of that puzzle. I wonder how investors have received that, and if you think that's an additive or a risk point.
Well, I mean, there's always geopolitical risk, in any securities, right? I mean, you never know what's going to happen. But the reality is that you're investing in AI infrastructure. There are international companies that you cannot get away from. I mean, Taiwan Semiconductor, right? I mean, they build all of the chips for NVIDIA, for AMD, for Apple. Without them, there is no AI infrastructure. So to have an AI product that doesn't have them as in the appropriate weighting is silly. Same thing as an SK Hynix. I mean, they are the leader in what they do, and without them in the supply chain, there's really no replacement for them. So, the international exposure is key to the supply chain and to making AI a reality.
Yeah, that's fair. I want to make sure we hit POW too, because you got a great ticker zooming in basically on the electricity specifically as a resource, as an input. GE Vernova, another one here that plays a role. How do these two differ, and do they serve the same type of goal? Do you view them as you pick one or the other, or do you view them as they play off each other? Tell me about it.
Yeah, they're bookends. They're made to be used together. So AIS is the AI intelligence infrastructure. It's data centers and semiconductors. What POW is, POW, is the physical AI infrastructure. It's the grid, right? The grid in the United States is on average around 40 years old. Everyone's talking about all the power needs of the AI data centers, but guess what? We have energy, but we don't have power. So we don't have an energy problem in the United States. We can't take that energy and create power and distribute it to where it needs to go. That is the problem. And that's a national security risk as well for a variety of reasons. So what POW is, it's all about the AI energy and power infrastructure. And if you look at the CapEx spending there, we use the same exact process as we do with AIS. It's the supply chain, it's the bill of materials, and the analysis. 50% of the CapEx spending that needs to go into building out the grid is in transmission and distribution. So while everyone's talking about renewables and generation and nuclear and all that stuff, it's important. It's a small piece of the puzzle, though. The biggest piece is transmission and distribution. And these are switching companies. These are cabling companies. These are the companies that are, again, critical to making sure that we have the power to run our AI infrastructure.
Transformers, HVDC, that one I don't know. Substation switchgear, cooling systems, all stuff that are going to be very much picks and shovels, but for a specific category of picks and shovels, right? So this is almost like a subsector to some extent. Is it going to be a higher beta play to the overall theme then?
No, I would say it's lower beta because it's comprised mostly of industrial companies and energy technology companies, but and they're very large companies as well. And I don't think it's too niche-y. I think it's very broad. In fact, these are companies that are building out or are required to build out the global energy infrastructure for the world, right? So these are companies, again, building the picks and shovels that are providing them that we cannot get away from using in order to upgrade our grid. And it's not only for AI data centers. Right now, the grid can't even handle consumer demand. It can't handle cyber attacks. It can't handle, God forbid, an EMP attack. It's not hardened. So, putting aside AI data centers, grid upgrades is something that needs to happen in the United States and needs to happen now because there's a long lead time. Then if you add AI data centers, it's taking demand for power 10x over the next 3 to 5 years. So you can see the demand curve here. Trillions of dollars are going to be going into building out the grid over the next 5 years. And that's what POW is trying to capture.
POW, a little bit newer, right? You launched this last month, is that correct?
Yep, it's a new product, a month old. AIS is going on a year in a few weeks in December. So, but it's the same exact process. It's the rules-based process. We have the active managed investment committee on top of it, except with this investment committee, we actually added an expert in energy technology as well, one of the global luminaries in that space. So again, it's people that are doing it on a day-to-day basis that understand the technologies, understand the supply chain, and not just Wall Street analysts doing analysis and picking numbers. It's people that are on the ground doing it, and that's how we feel like we have an edge.
Okay. Like the names in here, some fun ones that you don't hear very often. Definitely an international element there too. So that one we'll watch. We'll see how it develops. It's still a little bit nascent, but Holy smokes, AIS, a little known way to crush the AI trade so far this year, beating a lot of the other ways that I watch that sector. Different proxies, different benchmarks. So pretty impressive stuff, Adam. Thanks a lot.
Thank you for having me. I appreciate it.
Absolutely, really good stuff, really interesting. Adam Patti, CEO at VistaShares. All right, we got about 12 minutes into the bell. Quick break, coming back. We'll close up this market, go through the risk radar, look at some charts next. There are two things about Chicago finance you can't get anywhere else. The first is kind of hard to miss. Everyone's trading options. Cboe is on a 5-year growth streak making billions, and its goddess of grain sits atop the final pit of open outcry. And that's what it's all about. The chance to fend for yourself. A fortress for the self-made trader, and the only still standing in America. The second thing you may not know, but it's worth trillions. Chicago is the only major city in America that's home to 2 of the top 10 registered investment advisors, according to Barron's. That means a steady river of passive money and fixed income pouring into the city. If you think you can beat the market, this is where you do it. If you've got value, price will discover you here in Chicago, the future of finance. Join me, Oliver Renick, from Cboe, Tuesday, Wednesday, Thursday, into the closing bell, live from Chicago. Welcome back to Chicago, Future of Finance. I'm Oliver Renick. We have about 9 minutes into the bell here. S&P is having some trouble. I got Mr. Scott Bauer joining me from Prosper Trading Academy as we look at the market here under some pressure. Scott, I've had the yellow on stocks, red on coins, but I'm wondering if I'm going to have to flip this light on equities red if this thing can't close above 66. What do you think?
Boy, this is ugly. This is really, really ugly. I'm not sure how else we describe that. The 66, I don't see that happening here.
We battled for it all day and lost it.
I know. I don't know that that's going to be, and I'm looking over here at the live quotes. I don't know that that is going to be the line in the sand here, but this is really ugly. And, the last couple days, Oliver, we've talked about, even on these sell-offs, the VIX, maybe moving a little bit here, but not really into some worrisome territory. Today made, I would say, the breakout move to the upside that we hadn't seen. So that concerns me a little bit here. And it really concerns me more so that the economy, or not so much the economy, but the market is really holding its hat now on what the Fed does. And to me, it just doesn't make sense. It really doesn't, unless there's a deeper concern that not only are they not going to cut in December, but boy, this inflation thing is really out of control. And I'm going to say out of control, yes. And that maybe that's putting some question marks into even in the first quarter of 2026. So I think the market is preparing itself for that, preparing for the worst, and that's what we're seeing.
Yeah, the breakdown, big red candle today, pretty nasty stuff. As far as bonds aren't doing much,
No.
The treasury market, TLT, basically just sitting here, 10-year yield sitting at 4.1%. So, I'm not like too worried about some of the, I guess, Fed stuff yet, but to your point, you don't know what kind of complications that could add to it. I don't think it's the cause right now, but it certainly is potential for ongoing risk, if you will.
Yeah, and you know what's kind of concerning is look what's happening in Japan, and look what's happening to the long end of the rate curve there. So we know that Japanese investors, they're one of the largest holders of U.S. Treasuries. And so when we look at, some swaps perhaps, or we look at some currency valuations there, what might happen here? Well, 3.5, 360, 370 on the 30-year JGB, that's like record territory. I have a feeling we're going to start seeing people, selling U.S. Treasuries all of a sudden to buy now Japanese bonds. And if we start to see that, we could see a pretty big shift up in rates here if that really starts to happen. I think that's got to be something that's on
the potential for kind of carry trade re-entering the conversation. I'm looking at the Kalshi odds for December, and right now 65% is where they're putting the odds of the Fed maintaining the rate. Cut is only 34%. So I guess to your point, that might be a factor here that maybe I've underestimated, because those odds are shifting, obviously, and the cuts have gone down from October around 80% to now 34. That's a notable drop. I'm sure that's not really helping the situation. We could have a whole conversation about whether or not the economy really needs it, but I feel like that's just, look what the market's telling you, and the market's telling you the odds of the cut are going down, which is, maybe it's not a negative, but it certainly is not an added positive.
It's definitely not a positive, and again, it's not a positive because the rhetoric has completely shifted from the Fed. Even some of the Fed heads that just a few weeks ago were saying that they still supported a cut in December are now starting to balk a little bit, are now starting to hedge a little bit. Because,
like Kashkari.
Yeah, I mean,
Collins was hawkish.
Look at Austin Goolsbee also. And I don't think he's a voting member, but look at him, and he was one of the bigger doves out there, now saying, boy, this inflation is way more difficult than we thought it was going to be. So if that's the
when you lose the ghouls,
right? Absolutely, there is no question about it. So
our local Chicago dove.
Yeah, the Chicago dove. That's right. And that jobs number this morning. How much do we read into that? Right? I mean, is it really reflective of the job market now? I mean, the data is so old, but yet it came in at a much stronger number than the market expected. So that's another positive, or I should say negative, for the Fed potentially lowering rates.
That's kind of an interesting one that I do think is maybe worth a discussion real quick too. To your point about the number this morning at 119, it's not like it's not a problem to have jobs, but if you've got a trade based on bonds, based on cuts, this certainly is not going to help it. I'd rather see the high number than the cuts, but again, that is very much depending on how one is positioned according to bonds and what they're what they think from the macro side. It's nice to have data coming in at least, though.
It is nice to have data, but if people were concerned that the data that we were getting on a timely basis wasn't necessarily accurate, how do you describe what we're getting now? I think until things shake out months from now, 2-3 months from now, when we see revisions after revisions, which we're absolutely going to get, I don't think we're going to know what the accurate data really was. And it's not because it's not being collected accurately or anything. It's just because now it's lagging so much.
Right, yeah, very true. Not giving us much. Hey, last thought, Scott, is we'd be remiss if we didn't talk some crypto here, given how much we've discussed it, and also the fact that MicroStrategy just again today was down, and it was down a lot early, which, we were hoping that crypto would just do crypto things in it's in their own category. But now that if stocks maybe have lost the NVDA bid, I do kind of wonder, if this is just going to get worse, which is an incredible thing to think about because it's already been so bad.
Exactly. I mean, I know that in the Bitcoin space, some of these liquidations are just continuing on a very, very large scale of whales that have held Bitcoin for quite a long time. So again, we talked about this yesterday, Oliver. How much is this drop in Bitcoin really tied to the expectation that the Fed may not cut a quarter of a point? There's got to be more to it.
Yeah, if it's that, then good luck, man.
There's got to be more to it than just saying, oh yeah, it's down because the Fed's not going to cut next month. I don't think so. There's definitely disconnect happening here. And maybe we get some bottom fishers coming in here. Maybe we get a strong rally. But again, we talked yesterday, and I was using the 100,000 level yesterday. I'm gonna lower that now and say the 92,000 is really the area that it's got to break to the upside. And if it tries to rally there again and hills, we're gonna see 80.
To your point, looking at the chart, we did get a lot of resistance there at 92.5. There's the bell, Scotty B. We got to jump. Thank you, sir, as always. Appreciate you, Scott. Have a great night. Scott Bauer, CEO of Prosper Trading Academy. Thank you for joining Chicago Future of Finance. We are out of here. Have a great night.